Hello and welcome. As a talk tickers analyst, I see a lot of things trip investors up, but there's one rule, especially around tax time, that causes more confusion than almost any other: the wash sale rule. It's this crucial but often really misunderstood part of the tax code that can turn what you think is a smart financial move into a pretty costly mistake. So today, we're going to pull back the curtain and demystify it completely.
So let's set the stage with this classic dilemma. You're looking at your portfolio, you see a stock that's deep in the red. It's a big paper loss, but you still believe in the company, right? You think it's going to bounce back. So the question is, how do you harvest that loss to lower your tax bill without actually getting out of the investment and missing that potential rebound? This is the exact puzzle the wash sale rule is built around, and understanding it is absolutely key. So let's dive in.
All right, here's our game plan. First, we're going to decode the basic rule itself. Then, we'll get into the weeds of the substantially identical puzzle. This is the one that really gets ETF investors. After that, we'll look at some serious risks involving your IRA, see where the rule might be headed in the future, and then wrap it all up with the key takeaways you need to remember.
Okay, first things first. Before you can even think about mastering something like tax loss harvesting, you've got to understand the fundamental rule that governs the whole process.
So at its heart, the rule is actually pretty straightforward. The IRS just wants to stop people from creating what they see as artificial losses. I mean, think about it. They don't want you selling a stock for a tax deduction on a Monday just to buy it right back on Tuesday without ever really changing your economic position. It's all about preventing gamesmanship.
And the way they enforce this is with a very specific and very important time window. The rule gets triggered if you buy a substantially identical security within 30 days before the sale, on the day of the sale itself, or 30 days after the sale. You add all that up and you get this critical 61-day period that you absolutely have to watch like a hawk anytime you sell for a loss.
So, what actually happens if you break the rule? Well, the key thing to get is that the loss isn't gone forever, it's just deferred. Let's say you sell for a $1,000 loss, but then you jump back in too soon. You can't claim that $1,000 loss on your taxes this year. Instead, that disallowed loss gets added to the cost basis of your new shares, so it effectively just pushes that tax benefit into the future until you eventually sell that new position.
Okay, so selling and rebuying the exact same stock is easy to understand, but this is where we get into the most confusing and debated part of the entire rule. What happens when the investments are, well, just substantially identical? This is where the gray area begins.
And here it is, the million-dollar question for pretty much every modern investor who uses ETFs. Can you sell VOO, Vanguard's S&P 500 ETF, to book a loss, and then immediately turn around and buy SPY, State Street's S&P 500 ETF, to stay in the market? Does that count as a wash sale? The answer is, well, it's a huge gray area. This quote from an online investor forum just nails the confusion perfectly. Your brokerage might not flag it. They might process the trades just fine. But that really doesn't matter. The only opinion that counts is the IRS's. And that only comes up if you get audited. And with no clear legal precedent, you, the taxpayer, are the one taking on all the risk.
And honestly, you can make a really strong case that they are not identical. I mean, just look at the details here. They have different sponsors, different expense ratios, totally different legal structures. One reinvests dividends right away, the other holds them as cash for a bit. One lends out its securities, the other doesn't. These aren't just cosmetic changes, these are real, significant operational differences.
But, and this is the absolute kicker, despite all of those clear differences, the IRS has never come out and given a definitive ruling. So what does that mean? It means one of the most popular tax loss harvesting strategies out there today is still operating in this legal fog, waiting for a clear answer that, frankly, might never come.
Okay, now let's pivot from that gray area to a situation that is dangerously, and I mean dangerously, black and white. Because if you get this next part wrong, your loss doesn't just get postponed, it disappears forever.
It really does seem like a clever little workaround, doesn't it? You sell a stock for a loss in your regular brokerage account to get the tax break, then you immediately buy it back inside your tax-sheltered IRA to maintain your position. It makes a certain kind of sense on the surface, but let me tell you, this is one of the biggest tax traps an investor can fall into.
Yeah, the IRS is way ahead of everyone on this one. All the way back in 2008, they issued something called Revenue Ruling 2008-5 to address this exact scenario. And their answer was crystal clear and very, very costly for the investor.
And this is maybe the single most important thing to remember from this whole discussion. When you trigger a wash sale by repurchasing a security in your IRA, the loss is disallowed permanently. Unlike a regular wash sale, you do not get to add that loss to the cost basis of the shares inside your IRA. The tax benefit is gone. It just vanishes into thin air, forever.
And the risk here expands even further when you start talking about related parties. You might think, well, the rule only applies to my accounts, but what if you sell a stock at a loss and then your spouse immediately buys it back in their account? Well, the courts have shut that down before, calling it an indirect sale. The point is, the IRS has multiple tools in its toolbox to enforce the spirit of the law, even if it's not a technical wash sale under the original definition.
So if your strategy depends on some of these gray areas, here's a word of warning. They might not be gray for much longer. Lawmakers are very aware of these loopholes, and they are actively looking for ways to close them.
We can see exactly where this is all headed by looking at recent legislative proposals. Congress wants to expand the wash sale rule to finally cover things like crypto and foreign currencies. But more importantly, they want to explicitly write into the law that a repurchase by a related party, which they define broadly to include your spouse or even your own IRA, officially triggers the rule. This would turn a lot of today's murky gray areas into clear-cut black and white violations.
All right, we've covered a lot of ground. So, after all of that, what are the most critical things you need to walk away with? Let's just boil it all down to the essentials.
Okay, here are the 4 things you absolutely need to know. Number 1, the IRA trap is real, and it is costly. What is normally just a deferral of a loss becomes a permanent, unrecoverable loss. Number 2, that popular ETF swap strategy, it's still a risky gray area. Number 3, the rule can be triggered by people related to you, like your spouse, and that definition is likely to get even broader. And finally, number 4, at the end of the day, it is on you, the taxpayer, to be compliant, not your broker, you.
So that really leaves us with one final and I think very important question. As you see these tax laws evolving, and as you see lawmakers looking to close these loopholes, you have to take a hard look at your own strategy. Is it built on solid ground, or is it built on shifting sand that could just give way at any moment? This is not financial advice.